We start today's market talk in a super cycle built on largely unproven bets: AI infrastructure, semiconductors, defense, new energy, etc. How much do you keep spending before you are asked to show the returns? This problem erupted with Tata Group, and it is a similar problem which is there or which is impacting the AI hyperscalers in the US or the AI related stocks in Korea and Taiwan, etc. So the problem is between aggressive new bets and capital discipline. It is playing out in boardrooms across the country, and this is one of the reasons why even Reliance is subdued for a long time, because they are making a lot of bets on new energy, and it is taking a lot of time to generate any value. So all these bets, like which Tata Group had on semiconductors, Air India, Tata Digital, most of these businesses are having substantial losses, and the return on capital is not really visible. And that is the reason why all these stocks, because of the resignation of the chairman, started correcting last week. The other issue is related to this is Nifty IT, because TCS impacts the Tata Group. Now, if you see here, this is IT index. It made a low, uh, the low from where it has been bouncing and then bounced, went to a resistance, and then it is consolidating here, because for IT services, outcome based AI contracts are forcing exporters or all of them to rethink how and when they will bill clients. Deflationary AI deals could weigh on revenue growth and margins for years. Roughly around 13 billion in IT contracts, $13 billion in IT contracts are up for renewal by year end. And revenue growth is lagging right now despite strong deals being signed. Indian IT companies have to defend margins and revenue while managing transition from labor arbitrage to technology led productivity. This is one of the reasons for underperformance of Nifty for this year. It went up and then it is just consolidating, looking for fresh trigger, and now the trigger is also out. So we don't know how it will go from here. Market outlook. You see, we have finished with earnings season for the first quarter of FY27. Net sales growth for the non-financial sector provides strong evidence of demand resilience and pricing power. So the net sales growth of non-financial sector is 22.5% year on year, higher for and even higher for manufacturing sector. And that is why you are seeing such strong earnings growth now in a lot of companies. Wherever there are margin pressures, they are due to petroleum products or higher cost of inputs. So it shows resilience and pricing power. Next is Capex revival is spreading into new age industries such as data centers, global captive centers, defense, space, and renewable energy. And these two things are the key issues which we have to focus on while selecting stocks for investment. One is demand resilience and pricing power, and the second issue is capex. Now let's take some examples. Hindustan Aeronautics order book is 2.5 lakh crore, supported by 97 Tejas Mark 1 fighters, 156 LCH, 8 Dorniers DO 228 aircraft. It is expanding its engine manufacturing capacity from 24 engines annually to 30 engines per year from FY28. It is planning to invest 12,000 crore by 2030 towards LCA Mark II, GE F404 engine facilities, and Indian multi-role helicopter facility. Just for information, FY27 expected EPS is 154 rupees. It means it is at around 32 times P. not very expensive, but doing Capex. The other Capex story is Bharat Forge. It is pivoting to defense, aerospace, marine, and other industrial segments. Defense order book is roughly around 11,196 crore. They recently got orders for 12 marine gas turbine generator sets in this quarter only. So they are getting into naval defense infrastructure also. It is setting up a dedicated forging and machining capacity to serve new sectors such as defense, aerospace, data centers, and semiconductors with a capex of 1800 crore. FY27 expected EPS is rupees 27, so it's at around 76p right now. But the point to be careful is they will have to do a fundraise, so a QIP or preferential issue of roughly 2,500 crore to support this. So the stock is slightly underperforming. Then Keynes Technology, OSAT and PCB businesses are expected to begin commercial production from Q3, Q4 FY27. It has invested 473 crore in OSAT and plans another 300 crore in FY27. Order book is 8,900 crore. And prototype satellite is under development with for a launch in mid FY28. It has entered titanium gas bottle manufacturing for space programs. It is planning to do 8,500 crore capex through FY28 in OSAT, HDI, PCB, camera modules, etc. Now, FY27 expected EPS is around 68. It's at around 55p. So enough of capex. Then the biggest of them, power grid. It commissioned 1635 circuit kilometer of transmission lines and 10,500 MVA of transformer capacity. 37,000 crore capex guidance for FY27. 1.19 lakh crore bidding pipeline. FY27, it is expected to do around 16 rupees EPS and it is at 17p. But it is going to give a lot of contracts for transmission and distribution. The new grid investment is being pulled by AI and EV demand. So that is where the capex is going. Then India has so far been remarkably resilient despite all the geopolitical headwinds. Consumption demand has been robust. Let's talk about consumption. Titan jewelry segment growth of 30% margins improved, though it was helped by inventory gains and MTM gains due to inventory hedges. It expects to double revenue and EBIT by FY30. I'll repeat, it expects to double revenue and EBIT by FY30. Right? So 4 years it is planning to double the revenue and operating profits. FY24 EPS is rupees 75. FY27 it should do around 75 rupees EPS. So it's at around 65p. Then Hero MotoCorp, 22.7% volume growth and 10.6% rise in realization. Export volumes climbed 63% year on year. Gain in market share in 100cc, 125cc motorcycle, EV scooters. 1,500 crore capex in FY27 to increase Splendor capacity and EV manufacturing capacity. It is expected to do rupees 289 EPS in FY27. So it's at around P of 20. Then Tata Motors, 26.3% volume growth, market share is up, margins down, 2.5% price hike they took in July. So and they are also doing a acquisition of Iveco of Italy just to increase their total addressable market to Europe also in terms of commercial vehicles. Right now it is, I think, fully priced, but it is showing how the consumption demand is robust. Now coming to the US CPI was stable and core inflation slowed. PPI was flat. So the short end yield, that is 2 year, stabilized, corrected, and is cooling. as core CPI, PPI data dampened expectations of a Fed rate hike. So just switch off your volumes. So it dampened expectations of Fed rate hike, and so the short-term bond yields are coming down. Now, if you see the 10-year yield, 10-year yield is moving up, and similarly the 30-year yield is showing upward pressure due to heavy treasury supply and weak demand at long-term bond options. So if you see the yield differential between the long end and short end is increasing. So this should be good for gold, silver, cryptos, etc. So now the next thing is Brent crude. It gained 8% due to geopolitical risk premium. It gained. So right now it's a stalemate right now in the Middle East, so nothing is improving. Copper is static. It's a tug of war between demand and supply. Gold, as I mentioned, surged beyond 4,400 ounce, but then it profit booking was there. So it is now right at the last resistance. Once it breaks out from here, then you will see higher levels, somewhere closer to $4,800. It should be the next target, basically helped by the soft inflation data. Same with silver. Again, it is being held by central bank accumulation, provides a strong demand flow despite fluctuations in dollar. So it is also the next target should be around $70,000 for silver. Bitcoin, it consolidated basically because surging crude and rising bond yields pulled liquidity from speculative assets. So it is consolidating right now. Dollar index below 100 due to lower bond yields. So till the time it is below this, it is okay. US indices made fresh high, multi-month highs due to cooling inflation. So if you see, as I showed you last time, it has broken through that resistance and now it is headed to a fresh high. This is S&P 500. Nasdaq is still not gone up, not made a fresh high because there is a scrutiny on AI Capex and the return on investment, which I spoke about. Dow Jones has broken out, tried to go up, corrected, but it is benefiting from sector rotation into cyclical value, defensive industrials, and energy. But it is not coming down as such, so it has also broken out actually. Coming to FIDI data, FIs are net short on index futures, sold, and then they sold index futures, sold index call options, bought index put options. They are medium term bearish. Overall, if you see, they are bearish. Pros, net short on index futures, bought index call options, bought index put options. So net, if you see, they are mildly bullish because the number of call options they have bought, net is much higher than the rest of the futures and put options. Clients net long on index futures, sold index call options and sold index put options. But if you see net, they are bullish. So they are strongly bullish because they have sold roughly 6 lakh odd index put options. So they are strongly bullish. So the positioning is now very clear. FIs and pros are FIs are actually on one side and pros and clients are on the other side. So if you see this week, just switch off your volumes, please. Okay, so the FIDI data, if you see for the whole week, 10th August, this beginning of this week, 1.52 lakh short positions in index. It has increased to 1.77 lakhs, while index has actually come down. So they have added shorts and that has led to the index also slowly declining. It has now There was never a steep decline, and they have slowly added short positions in futures and in options. Now coming to Indian markets, so the rupee is generally stable, not moving much. There was some positive commentary on uh, decent uh, inflows of dollars. So it is FCNR deposits. Bond yields are again stable, nothing much here. India VIX has come down. It is below 12 now. And if India VIX remains low, then don't expect big moves in the market. So it's a low volatility environment. Nifty, if you see, it made a bearish candle on the weekly charts. It's below that, much below the breakout point. On the daily charts, if you see here, it had broken through this resistance of 24,600, but has slowly and gradually come down. Uh, all the moving averages have flattened out. If you see here, they all flattened out, and it has closed below, though it corrected, just stable, but it has closed below the 200 EMA. Daily RSI is also in a falling mode. So if you see here, this 24,200 is a support, that is 50 EMA, and 24,600 should be a resistance. So it will remain range bound here. And the way it is moving because of stagnant improvement in the Middle East crisis and higher oil prices, it is slowly drifting downwards. And now there are no fresh triggers till the time the next earnings season starts. Autos, which was a leading sector, corrected a bit, but still it is strong. Nifty Bank, again, a bearish candle. It is slightly better off, but it's sideways actually. On the daily chart, if you see, this was a resistance, 58,800, and it has been on a gradual sideways movement. It has led to flattening of the moving averages. RSI is neutral. For it, around 58,000 should be a resistance. It has to cross this first, and 57,100 or to 57,000 is a support. In terms of sectors, defense, auto, PSU banks are looking strong. Midcaps are in good momentum, made a fresh high. So this segment of the market is doing well. Nifty small caps, it corrected at end of the week, but still it nearly made a fresh high. So it is also in good momentum. The problem is HDFC Bank. It is just now consolidating at that 725 level. Let's see which direction it takes. There has to be some new trigger. It is nearly oversold. Reliance, again, is stagnating, as I had mentioned. It is basically return on investment issue. They are doing a lot of investments, but results are not, because there is no ROI. So all their new investments are not really giving a push to the profits or the margins. So that is why it is also consolidating. Now I'll cover two stocks. First is Lumix Industries, market leader in the Indian automotive lighting segment with a dominant 60% market share in passenger vehicle lighting. It operates through a technical and equity collaboration with Stanley Electric Japan, which holds a 37.5% stake. LED lighting commands significantly higher content per vehicle compared to conventional halogen bulbs. As OEM models adopt connected adaptive LED light bars and front grills, its realizations continue to expand. It maintained EBITDA margins at 9% in Q1 FY27 despite 120 to 130 basis point cost inflation, while management retained FY27 margin guidance of 10.5 to 11%, including other income. Its order book is at around 2,500 crore, 55% of FY26 revenue, with 90% comprising LED products. Its Bangalore facility, catering to Maruti, Suzuki, and Toyota programs, remain on track for commissioning in Q4 FY27. Sanad and Bawal expansions are underway. The company raised FY27 Capex guidance to 200 to 250 crore, driven by recent business wins. Key near-term risks include input cost volatility, delayed OEM price recovery, import dependence in complex electronics, and slower adoption of advanced lighting in CVs. If you see, they have in-house technology development. So in terms of lighting, rear lamps, LED headlamps, ultra homogeneous luxury LED signal lamps, portfolio of low profile headlamps, projector modules, headlamp module and controls, grill lighting with animation, image projection modules, innovative interior and mood lighting, etc. So they are doing well in terms of lighting. Now coming to their earnings for this quarter, uh, total operating revenue grew around 32.6%, while manufacturing revenue went up 36.8. EBITDA was up 33.7, margins stable. Profit after tax grew 41.2%. So strong earning growth in this quarter. As I told you, decent revenue growth. If you can see the chart over the last 2 years, uh, then margins have expanded year on year, but they have dipped, but that is normal, it's expected. PAT has grown decently, so it is doing well. And LED and non-LED revenue mix is generally stable, but LED is 63 and non-LED is around 37. So if you see their client mix, uh, TVS, Toyota, Tata, Mahindra and Mahindra, Hero MotoCorp, HMCL, HMSI, Honda Motorcycle and Scooters India, and Maruti. So their main clients remains Mahindra and Mahindra and Maruti, and others they are trying to grow now. Segment mix wise, if you see, uh, personal vehicles is a major, then two-wheelers and CVs. So they are basically into lighting up personal vehicles, hence the contract with Maruti and Mahindra. Revenue expected to grow at 17.9% CAGR over the next 3 years. EBITDA projected to increase at around 19.5 CAGR. PAT is anticipated to go up at 25.9 CAGR. ROE, ROC are improving. So they are generally doing well, and decent growth is expected over next few years. And the key issue is the content per vehicle. That is the key issue. The lighting content per vehicle is what is increasing. So what they are expected to do is they are expected to do around 5,922 crore in FY28 revenue, and EPS adjusted profit of around 302 crore and EPS of 323 crore. Oh, sorry, 323 rupees. So this is what is expected of them. So revenue growth of around 20% over the next 3 years, EBITDA growth again in the same range, and PAT growth of around 24-25%. Margins are expected to slightly improve, but they remain volatile. So at FY28, if you see 323 rupees earnings, it's at around 18 times FY28 earnings with decent earnings visibility also. 20% consistently they should grow. So that should not be a problem. So it's a safe business to hold. So let's see the chart. If you see after the earnings, it went up. Now it is coming down. So every dip to somewhere around this 5,600 is a buying opportunity as an investment for long term and below that. So and periodically, if you see the chart, it goes up, corrects, takes support at around 200 EMA, and then it moves up. So from 5,600 should be the first entry, and then after that, every dip to the next set of moving averages up to 5,100 odd should be a decent opportunity to get into this stock, because right now the market is getting into a correction mode, so that should be good. Next is TD Power. Products are generators for turbines, generators for engines, generator for special applications. It makes motors, induction motors, synchronous motors, traction motors. It's a specialized electrical engineering company focused on manufacturing custom designed AC generators, motors, and electric equipment one of the few global players positioned to benefit simultaneously from global energy transition, grid stabilization demands, and the rapid expansion of AI data center. So it is actually a beneficiary of the whole setting up of AI data centers and energy transition and grid stabilization and all these things which are working towards transmission and distribution. So it is in that segment. Strong operating momentum driven by robust global and domestic demand. It has successfully pivoted towards high margin international markets, primarily in the US, Europe, and Japan. In Q1 FY27, international orders accounted for 93% of total quarter inflows. So they are getting more of international orders now as compared to earlier. So they are growing their addressable market. Growth is anchored by thermal, hydro, biomass, and captive power plant demand alongside rising exports to Europe, US, and Asia. It designs custom generators co-engineered with global OEMs like Voith, GE, Jenbacher, Siemens, etc. Once a design is qualified with an OEM, switching suppliers take 18 to 24 months, creating strong customer stickiness. Management guidance points towards 35 to 39% revenue growth for FY27. They have recently raised their guidance also. They raised FY27 revenue guidance to 2,600 crore from 2,400 crore earlier and expects order inflows of rupees higher than rupees 2,800 crore led by exports. FY27 capex of rupees 50 crore is targeted to create annual revenue capacity of 3,200 crore for FY28 onwards. So it is in a growing segment. Let's see their earnings for this quarter. They did around 71% revenue growth, 72% EBITDA growth, margins slightly improved in a difficult environment, and PAT improved 72%. And even Q on Q, the PAT was up 20%. So there is a steady growth which is taking place because generally for all of them, the Q4 is the biggest quarter, but here they are growing from Q4 also. Now, historical financial highlights, revenue CAGR of 25%, EBITDA CAGR of 38.6, PAT 40. EBITDA margins have improved over the last 5-6 years, and PAT margins have also improved. And that is where it is reflecting in earnings now. Order book roughly 2,200 crores as on 30th June 2026. The biggest is exports, including deemed exports, 69.5%, domestic railways, space and aftermarkets, and some portion to Turkey also. So they are well diversified in terms of order book. Now expected earnings. So if you see here, they are expected to grow around 40% in FY27. So I think they should do well from here, roughly as they have raised the guidance to 2,800 crore of order inflow and net revenue of around roughly 2,600 crore. So that they should do. EBITDA margins are going to slightly improve, and net profit of 370 crore and EPS of around 23.7. So 23.7 for FY27 and then maybe around 29 odd in FY28. So they are at around, for FY28, if you see, they are around 50, and for FY27 around 62 P. ROE, ROCE are improving, strong ROE. So return on equity is strong, decent in terms of other parameters. Debt is negligible, so good, decent cash flow. Cash flow to PAT percentage is going to improve as expected in FY28. So that should be good. Receivable days, they should be able to reduce even inventory days and payable days. So they should once the cash flows are better, so they would be able to use their inventory and do their work. Requirement of working capital reduces, etc. So let's see the chart. It's a steady business. After this quarter, after the earnings, it did a strong gap up, and now it is at around 1,500 odd level. It is slightly overbought. So every dip from here is a buying opportunity if you can hold for long term. But one has to be careful because these kind of businesses are priced for perfection right now. But if you see the chart, it's a super chart. You see, it has constantly been above the, mostly above the 50 and 20 EMA. So it's a strong earnings. Every dip has got bought and accumulated, and then it has shot up now. So, and basically the news, the reason for this spike has been the increase in their revenue guidance for this year, FY27 plus, as the margins are improving. So people are expecting at least 40-50% PAT growth. I have finished. We'll take questions now.